think it's a new quarter for Wall Street, but there are definitely old fears on tech and trade, and it was an extremely ugly day on the market. All the major US indices are now officially in what would be described as a correction. In other words, they have dropped by more than 10%, and the final number is pretty unpleasant. Broad selling across the board. If I take you to the trading post, we can get a little bit more detail on exactly what is necessary and what's required. These records, by the way, all seem a long time ago. All three down, so please, red, I think, is the colour of the day. Not I think, I know it is. You have the Dow off 459, a loss of some 2%. It was about 3% at one point during the day, so a bit of a rally at the close. 2.25% for the S&P, and the Nasdaq, that had been well over 3% earlier. In other words, all 11 sectors were down on the S&P over the course of the day. If you look at FANG, and this is the traditional FANG, Facebook, Alphabet, and Apple, Netflix, and Google, then you've got Facebook now 20% off from its peak. Amazon fell sharply after a Donald Trump tweet, President Trump tweet, and accuses Amazon of abusing the postal system and killing retailers. CNN's Claire Sebastian is at the New York Stock Exchange. Joins me now. Claire, the market, as we're looking at these numbers, and the CNN Fear and Greed Index remains in extreme fear, but the market at one point, the Dow was off over 700 points. So a marginal rally, but still a very unsettled day.
Very unsettled, Richard, and you certainly get the sense of it down here. Volume ticked up over 600 million ahead of the close. That's around double what it was at lunchtime. But what we're seeing really here is a confluence of factors. We've got the trade wars, we've got the issues surrounding tech and the presidential tweets. You've got manufacturing numbers that came in a little below what was expected, along with reports there of worries from companies about those tariffs and the impact that it's having on their business. So I think, you know, this is the start of the second quarter. I don't think we're seeing any of the volatility that we saw in the first quarter dissipate.
We'll talk about this with the next guest, but put it into perspective. It's the various catalysts for what takes place and the severity and extremity of the move that seems to be unsettling.
Yeah, absolutely. They don't need much at the moment, Richard. The fundamentals, as you know, are still strong. The earnings have been pretty strong, and those really are the things that underlie the market. But it's these triggers that we've seen recently, be it chaos in Washington, be it talk of a trade war. That talk of a trade war really is something that can have the power to roil these markets. So I think, as you say, triggers is the thing, but volatility is something that is playing around with the market at the moment.
Are they talking about buy on the dips?
Today, I don't think that was the case. Obviously, we came off the lows of the session. The Dow was down about 750 or so points at its worst, and we have come off that, which is something of a change, Richard. Throughout February and March, what we really saw was the selling take place in the last hour of trading. So perhaps we're in a slightly different, slightly more measured approach to the selling at the moment. There was a technical level on the S&P 500 that was breached today, which did spark some of that selling in the afternoon. But as for buy on the dip, I think tomorrow will be a big teller on that. We've also got the Spotify IPO coming out tomorrow. What a time to be listing a tech company.
Claire Sebastian of the Stock Exchange, thank you. Volatility is the key of the day. You saw that with the VIX, which rose some 10-12%. Joining me now, Ross Gerber, the veteran money manager, leads Gerber Kawasaki, which has more than $500 million in assets under management, joins me from the West Coast. Very difficult to know what to make of a day like today. When you know, look, Ross, we saw the presidential tweet on Amazon. You've seen the trade and the China retaliation. Are these the reasons that the market is deciding to sell off?
Absolutely. I mean, when you have such an unstable president who constantly is meddling with the status quo in a negative way, it's very hard to build confidence to make a long-term investment on the future of America. And that's making investors pause and say, hey, despite everything looking amazing in the business environment here in the United States and globally, maybe something we can't even quantify can happen with this guy. And I think that's a legitimate risk.
So where's the money going? Once it comes, I mean, is it staying in cash, money markets and the like? It doesn't look at the moment like there's a rotation into bonds.
Well, we've seen a little bit of a bid on bonds, but everybody's scared of higher rates, and we're definitely creating an inflationary environment in the United States based off our immigration and trade policies, as well as government spending and the need to borrow more. So bonds aren't necessarily the safe haven they used to play. And so I think cash is piling up, and that's what's happening at my firm. The #1 position we actually have is cash at my firm, because as we actually like these opportunities to get into our favorite names during corrections like we're seeing now, but it's been a long run up. And, you know, I have to say, this is just more volatile than people are used to in the last 2 years, but this is pretty normal, actually.
I mean, this is the new normal, and it is predicated on the back of algorithmic trading and other forms of movement. But look, you know, when this latest down leg began, say a week ago, 10 days ago, many would have thought, myself included, do I take profits off the table? Do I, you know, money that I've banked already, money I've made already, should I just keep? Well, I didn't, and others won't have, and I guess now I've got to ride this out.
Right. And you know, I always say you want to be positioned for the correction before the correction, not after. And we tend to build portfolios around the concept of stress tests of what happens if. And so we were prepared for this type of downturn. It doesn't make it any more fun. But as long-term investors and somebody who's been doing this my whole life, you're always going to be somewhat invested in the stock market, even during the worst of times. And I have to remind people that when you feel the worst about the stock market, it's usually actually a good time to invest. So it's very, very hard to market time. So you build a good portfolio, you stick with great names, and you'll make it through.
And Ross, I come back to your first answer. You know, if I take what you've just said and you see it through, or you stick through it, but there is this, and I'm not making a political comment here, but there is this mercurial element which cannot be predicted, which is the next tweet from the President of the United States. You know, there used to be a rule in constitutional law that governments don't target individuals, or governments don't target individual companies. It's always been a tenet of common law as well. This president's doing both.
Well, you know, I've turned off his tweets, and I do everything to avoid any information I'm getting, because it's constantly changing and constantly wrong in a lot of cases, where they'll do one thing and then reverse it the next thing. So, you know, the political risk is huge, and I'm not trying to minimize it, but the stock market is ultimately about money and making money, and corporations are making a ton of money. They have so much opportunity to use this money right now. So it makes us bullish on business as much as we're bearish on government. So the real issue that you're bringing up is, how much can the government really screw up business, especially a government that's supposed to be helping business?
I love that, Ross. Stay with me. Bullish on business if we're bearish on government. Stay with me, because we are going to talk more about Tesla after I've just briefed on the subject. Elon Musk's efforts to shrug off Tesla's woes aren't helping the share price. Join me at the super screens and you'll see what I mean. All right, the Tesla share price. The stock is down nearly 6% today, and 20% so far this year. You can see how the stock literally fell off a cliff over the course of the day. And the reasons can be quite simply seen. First of all, Model 3 sales are likely to miss expectations because the ramp up in production has not been possible. And Elon Musk's April Fool joke about the company's health fell flat. He was poking fun at his critics, and he tweeted a picture of himself slumped against a car with a sign saying bankrupt. Now, Tesla is also in trouble with the NTSB. The company blogged about a fatal crash involving the Tesla, which was in autopilot mode at the time of the crash. The NTSB is unhappy about the release of the information. The crash is still under investigation. So, Ross Gerber, you were an early investor in Tesla. You see these problems of sales on Model 3, safety with the NTSB. Are you concerned? I mean, I guess that everybody's sort of writing off Tesla. Is it time to write off Tesla?
Well, absolutely not. And we're not concerned, actually. You know, what we're concerned about is Elon's media presence has actually become detrimental to the company, because I get where he's coming from, but as I've personally learned myself, you know, Twitter is a dangerous place.
Right.
So, you know, I get his joke, but unfortunately, you know, not everybody has a great sense of humor. That being said, Tesla is the safest car on the road. Okay, let's be real. If you fall asleep on autopilot at 75 miles per hour and the thing's beeping for seconds after seconds and you don't touch the wheel, I mean, you know, we can talk about this all day. The second thing, but the fact is that the Tesla is one of the safest cars on the road, and autonomous driving is here. It's a very early technology, and there's a lot of bumps in the road but this is going to make the world a lot safer place to drive. Automobile deaths are a huge amount of deaths, especially people under 45. And so we're very bullish on the technology and the company, despite it being a high-risk investment.
Ross, good to see you, sir. Please come back again from the West Coast.
Thank you for having me.
Love to have you on the program. Thank you very much indeed.